Hey guys, it's Max. Today I wanted to talk about, I wanted to review a couple of videos I did last week and one this week on GameStop option trades. GameStop is in play right now. Evidently, there's talk that it's being short squeezed again, and the Wall Street bets crowd and the Roaring Kitty and all those people, the meme people, are in it. So volatility is going through the roof. Well, I have a really sweet way to play meme stocks and also stocks that have earnings coming up. And we're going to show you an example on Tesla as far as that goes. First, I wanted to talk about why I like double diagonals and calendar spreads so much. That's the kind of trade I always show you guys whenever it's a meme stock or an earnings stock, a stock that has earnings like in the next week. Okay, so what a double diagonal is it's made up of two calendar spreads. A calendar spread is where you sell an option, either a call or a put. So you sell a call that expires this week. You buy a call, it has to be the same kind of option. You buy a call next week. You sell a call that expires this year. You buy a call that expires in 2026. Sell a call that expires in a month. Buy a call that expires in a month and a week. So it's just a staggered expiration. The whole idea is the whole idea of the trade is you're trying to take advantage of the fact that the option that's closer to expiration will go to zero faster. You're trying to play the relative decay between the two options. Anyway, it can be a great way to play meme stocks and earning stocks for a variety of reasons. But I want to talk about one of them real quick. Okay. So the calendar spread, like I said, is where you sell a call in a near week and then buy a call in a week behind that. It could also be where you sell a put in a near week and then buy a put in a week behind that one. A week it expires after that one. Okay. It has to be that way. The leg that expires has to expire first for it to be a calendar spread, for this to what I'm talking about to work. And that's the way that this is done. All right. It could also be done with calls and puts together. So you could also have a call calendar spread and a put calendar spread. And you could, so it's four legs, a bought call and a sold call, a bought put and a sold put. Anyway, you can enter that as one trade. It's called a double diagonal. And that's a good way to do these also. So that's always what I'm showing you guys is double diagonals and calendar spreads. But it's really all the same thing. Double diagonals made up of calendar spreads. All right. And all a diagonal is a calendar spread. All right, so these trades are income trades, or the way I structure them. So they bring in a premium, they bring in time decay, which is important. So they aren't sucker option trades like I show you sometimes, where you're long volatility, like on how to hedge the $1 million portfolio. You're just playing the sucker in that instance for the most part. But in this one, no, this is a positive. It's a chance to make money if the stock blows up, like what happens with these meme stocks. If the stock price goes up 50%, you can make money. And if the volatility goes up, you can make money. Anyway, I talk about these all the time. Well, today, some of these that we talked about last week are finally coming true. So we're going to go to option strat and I'm going to show you. But today's a good example of how they're supposed to work. Thing about these types of trades are, and this is true of calendar spreads, so it's also true of diagonal spreads, and so it's also true of double diagonals or straddle strangle swaps. I call them that too sometimes, but it's true of all these trades. If volatility goes up after you put this kind of trade on, you can profit more. Okay, typically when you do an income option trade like a covered call, like they do on ULTY, or when you do a iron condor, that's another. Those trades are short volatility. So if you put one of those trades on and then volatility goes up after you put one of those trades on, it pisses you off. It's because but in these calendar trades, if you put a calendar trade on and volatility goes up afterwards, you actually stand to profit more. Whereas in a covered call, you don't. In a covered call, you're capped, right? We know about being capped, but not only is your price capped in a covered call, when you sell the call, you've also capped the volatility. That short calls your exposure to volatility. So if the VIX is at 15 one day when you put on the covered call and it jumps overnight and goes to 30, but you've already sold this call, the very next day you could have sold that call for twice as much in theory. So it's an opportunity loss. All right, so let's get into this right here. Let me show you what I have. Let's actually look at this other window over here. This meme trade review window, and then we're going to get out option strat. Okay. I appreciate you guys for being here for this. I like to talk about the theory of options and option strategies, and these trades are my favorite trades. Okay, so this is one in GME, and there's a video. I showed this to you guys and even posted the link. No one sent me a message that they took the trade. I wish somebody would have. The trade had about $250 risk, depending on where you could have got in. It's a four-legged double diagonal, and it expires in 2 days. You would have sold at 30 call and bought at 28 call. So that'd be a call calendar for this week and next week. But then at the same time did a 25 put, sold a 25 put, but bought a 23 put for the following week. All right. If you would have done that right now, this thing is up pretty nice little amount. Let's look at these. All these meme trades and hedge trades that I've been making the videos lately have been doing well. All right. This one's up $171 that I'm showing you guys. I made a video. I want to say, I think it was actually, I think just a couple of days ago. Well, anyway, it doesn't really matter. We can look right here. It was July 10th, which is now. So it was last week. This was last week when I made those videos. But in any event, that's great. Now here's a smaller trade. I showed someone how to do it with a smaller amount of money, and this had just like $60 risk. But I said, do this 10 or 20 times if you want to do it for real money, right? But right now, and this is I was just showing how you don't have to use the puts. The put legs are not included. They're X'd out. This is just the call legs of that last calendar. So this is just selling a 30 call that expires Friday and buying a 28 call that expires last week. I mean, that expires the week behind that. At the time we sold that 30 call, it was worth 94 cents, and that was a ton of money. That's why we were selling it, trying to monetize that money. The IV was obscene. Well, unfortunately, the IV's gone a little bit higher in the meantime, but that's all right on this kind of trade because even though we're capped on this short right here, we have this long that doesn't expire till after it. So the volatility, this leg of the option gives us our long exposure volatility. So as volatility pops, what you can make pops. This is already right now. I could take this off for double what I put it on for. That's incredible on one because this is an income trade. This is a positive theta trade. And watch this. If a person just kept this trade as time passes, and this is just over the next couple of days, you can see the line goes up. Right now it's worth 120. As time passes, because of the rest of the time premium coming out of the short option, this trade could be worth, north of $200, and depending on where price goes also. Now, if the price in GME decides to turn around and go down, that sucks, but these trades have a huge buffer. The GME would have to drop more than 17% before this trade would net a loss, and that's in 2 days. Not that couldn't happen, but that's how these income trades work. These are like hitting for singles or like bunting, and they're really easy hits, especially when you put them on in a stock whose volatility is already high, but you think it could go higher. That's what it's for. Okay, now speaking of that, Tesla's not a meme stock, but they have earnings next week, either on Tuesday or Wednesday. So I also did a video last week and showed how to do a pre-earnings double diagonal, which is the four-legged trade. You guys have seen it before. Okay, so that's the profit and loss graph. But that's the trade we put on in advance of earnings. Now, this one doesn't expire. This one doesn't expire this Friday. the short leg expires next Friday. And why is that? That's because that's when Tesla's options are. So you need to have, the whole idea is to have your short legs in the week where the options are expiring. But the kind of confusing thing is you're just trying to play right up until they do expire. Then you want to get out in one of these ones that's before earnings, in my opinion. You guys tell me if you have a different way of doing this, but this is the profit and loss graph right now. So this trade's a little underwater. The dotted line's where the market is. But as time passes and more premium comes out of the short legs of the options, the short leg of those puts, this thing would be worth maybe, a couple $100. Now, at the same time, but that's right. We're taking it off. Earnings are the 22nd. So we'll take after the bell, I think. So we'll take it off right there. Okay. Well, anyway, wherever the market is right there, that's what you're aiming for. You're hoping the price of Tesla to run up into earnings, which it really hasn't yet. But if it would, this could be anywhere between a $250 to $500 winner. But even if Tesla blows up and it goes way beyond it, there's no upside risk. It's $348 no matter how high it goes. Well, that's not bad on $700 risk. That's about at 50%. And if you get right here in the juicy part, you have a chance of getting all your money back. But I like these kind of trades. So this is a double diagonal pre-earnings trade. So we'll monitor this one, and I'm going to take this one off, win, lose, or draw before Tesla's earnings come out. Because after Tesla's earnings come out, the implied volatility is going to collapse, and then it puts you in a worse position. These kind of trades are designed to be put on and for volatility to go up. If volatility goes down, that's what beats these kinds of trades. So these are long volatility trades. So anyway, let's see what else we have in here. Okay, just for some variety, the main GME trade I showed you was that four-legged trade. But I also put a smaller one on. I did a two-legged trade. You don't really need the puts. So, and I showed you that one. Here's just the call leg. So that's the 30 call and the 28 call. And this one, in real life, I have something similar on right now. But in real life, I'm getting ready to take it off too. This one's got about as much of its profit as its. I mean, this one is, only $60 risk. It's already a double where it sits right now. If a person had this and wants to hold longer, it could be worth, it could be worth more depending on what happens. But I'm going to take that one off in real life. That's a winner. That's how this trade is designed. That's what you're aiming for. You can hang on until, some people hang on and try to pin the strike. If it ends right on 30, because that's what we were selling. We're trying to get that 94 cents. The only reason we're buying this other option is basically just to get that 94 cents. The whole thing is to earn the 94 cents. It's an income trade. That's the whole idea. The income trade, that makes it where you have time decay working in your favor, and it gives you a slight advantage, or not kind of. Okay, so that one expires tomorrow, or actually Friday. I'm sorry, day after tomorrow. So this one right here, I did this morning, but it's the same type of trade, but it goes out 1 week further. So I'm just going to do one from scratch. Let me just show you one from scratch so I could show you how I do it. Okay, well, I start by getting the program to give me a double diagonal, and then I just remove the put legs if I just want to do it just a bullish call diagonal. Now, if I don't do anything, this is a out of the box double diagonal. That's an all right trade, but I don't want upside risk in a meme stock. See this, if GME blows up, which it might, be at 50, tomorrow morning or something. No, that's not going to work for this. So what I do, the first thing I do is what's on the bottom is the option you're selling. That's why it says -1. So first thing I have to do is change expiration. We need we're trying to go for the week of the 26th. Then the leg we're buying, we want that to be August 2nd. Okay. but it's the same thing. You don't want upside risk. So like I say, the first thing I do is identify an option to sell. So that one, you could buy it for $2, sell it for $1.86. It's a 189 IV. It's a 33. Let's see what the 35 goes for. Yeah, this is the one. Look at this. You can, it's tight bid-ask spread, plenty of volume, plenty of open interest. I'm going to put this one on or something similar in real life too. But all right, this is this looks like the prime option to sell. 203 IV. Let's see if we can hit a 40 up. Let's see if that's just too crazy. 40, you could get $1.09 for. Buy it for $1.18, sell it for $1.09. 225 IV, plenty of open interest. Do we dare look at the 50? Golly, the 50 is going for 69 cents, 65 cents. What about the 45? 45 for 84 cents. Well, we can only get 79 for it because we have to sell at the bid. You got to have to sell at the lower price. All right, I think this is the one. I think the 40 for $1.09. I'm going to assume we couldn't split the difference between the bid and the ask. Okay, then so that's what I do. That I first find the one that I want to sell. Okay, so then the other one, the long leg, is just you just move it until you find a profit and loss graph that you could live with. Or just hit me up in the DMs. I like to do this stuff. Or I can teach you one-on-one. There's better ways to do this, but just a real simple way to do this. Find the one you want to sell and then move this around. I move this around where I don't have any loss on the upside. To me, on a meme stock, that's unacceptable. There's some strategies where you're fine with that. But for what I'm showing you guys, you generally want to have, I generally want to have something that looks like that. All right. So this is the profit and loss graph at expiration. So you can see this trade has about $114 risk per contract. If that's not enough, do it 10 times and it's $1,100 risk. But $114 per contract. If the market goes nowhere, it looks like it's going to lose $39. And the reason is because the call's too far away. I'm going to move the call in. I'm going to move the call into the 35. Now that one doesn't bring in as much, but it's going to make it a higher percentage. Watch. So it's going to be $1.66. Okay, that's fine. Okay, this is like a little better mathematical trade in my opinion. Okay, so what this gives you is a trade that will, if the market goes nowhere, will make a little bit of money. That's not that important, that $20. It's just that it shows that the overall trade is theta positive. But what you're actually really playing for, like I always say, and it worked out for us this last week. That's what I wanted to show everyone. What we're playing for is if somebody put this trade on, they're playing for the volatility stays the same or even goes up more next week. Okay. And so, if the volatility even goes up a modest amount, 30% or something, then you're looking at if the market goes nowhere, and we won't hold it all the way till expiration, but we'll hold it in here. Market goes nowhere, you'd make, $90. And that's not bad on $120 risk. Yeah, $128 risk, no matter how high volatility goes. Yeah. But yeah, volatility gets jacked, and that's what's going to happen whenever Roaring Kitty tweets again. The price will probably double is one problem. It'll probably go to 40 or 60, but at the same time, volatility might even double or something because people will go crazy, and this little $120 trade will be worth $200, $300, $400. And the reason is because that's what I'm trying to teach people about how to play options on a deeper level. You have to be right about the volatility, more so even than the direction of the option. In some positions, in some strategies, you want to be short volatility where you anticipate volatility going down. Those are like covered call strategies, but this is the opposite type strategy. So I find this a really interesting strategy, but it's also similar to a covered call strategy in the fact that it brings in income. So I think it compares well to a covered call strategy, especially for a small account. All right, so let's save this trade, and then we'll look at this trade right here. Actually, see this little exclamation point? That means this option isn't very liquid. So we won't do that one because it might not simulate great. We'll do the next one down that's liquid. The 31 call is more liquid. And so we would have to buy that one for $3.30. And that's a bad, I always give myself bad fills, or, assume I have to buy at the highest price and sell at the lowest price. In theory, when I do these in real life, lots of times I can get get 10, 20, 30 cents better fill. And that really makes a difference too over the course of the year. But these are great little trades, great ways to play meme stocks. It's a great way to YOLO and have a little skin in the game. And you're still rooting for the price to go up. You want the price to go up. Because if the price these little trades, if the price just stays where it is, you just make 30 bucks. Even if volatility goes up, the price stays where it is. You make 50, 60, 80 bucks, which is fine. But if the price goes up a mere 20%, which is a lot, but not a lot for a meme stock, then all of a sudden this little trade is making some serious money. Because like I say, in a meme stock, when the price goes up 20%, volatility accompanies it. So, all right, guys. So we'll save this one for next week, and I'm going to post a link to it in case anyone wants to do this. And I'm going to call this, small account GME meme trade. So anyway, anyone that wants to look at it, or they can, I'll fill in the details later. Let's just save it like that for later. I may make some notes on it, but for now, I'll just post the link to it. We'll copy the link, and then I'll post the link to it in the comments of the video. All right, guys. Well, I appreciate you all for being here, and I will talk to you later. Have a good one.